It's always a privilege to take part in these events, and I enjoy it very much. So if you've got any questions, please do fire away. I don't bite, and if I do bite, I don't bite hard. So don't be shy. So let's, without further ado, let's kick off. We're going to be talking about how to trade the news in any market. And a lot of people ask me, how do I trade the news? What do I do at non-farm payroll day? What do I do when the central bank of, say, for example, any country is going to increase or decrease interest rates? And my answer generally surprises them. It's, I actually do nothing. And if you're baffled with what I'm saying here, don't worry, it'll all make sense in just a second, okay? But before that, I just want to introduce myself as Robert Colville. I have been trading for about 10 years now. This is my 10th year since discovering this weird, wonderful, and ever-evolving industry. And well, when I first started trading, rest assured, I made every single mistake in the book, many times over. In fact, I made every single mistake in the book 3 or 4 times over. So you can be rest assured I've climbed the mountain and I've managed to enjoy the view since then, and there's no reason why you can't too, because, you know, I got pretty average grades at school. I'm not an intellectual sort, but one thing, as anyone who knows me throughout my my formative years in trading will tell you, I just had raw, dogged tenacity and perseverance. And if you talk to any trader who's been around the block, one of my mentors, Larry Passavento, who you might have heard of, who's been a trader for 50 years plus. The main thing that kept him going through his dark years at the beginning was dogged tenacity. And any trader who I've interviewed actually recently, Nikola Delic, Vladimir Rybakov, they all started off and they did pretty badly to begin with, myself included, and many people I know who I've mentored who've started off have done pretty badly to begin with. And the one thing that keeps me in the game is a willingness to learn, tenacity, and to accept they're wrong. Okay, so just to give you a bit of background, started in 2007. I'm a set and forget swing trader. I trade predominantly Forex, commodities and indexes as my mainstay. Commodities includes precious metals, and since the inception of the Lazy Trader back in 2012, I've been accredited by the Society of Technical Analysts. The brand The Lazy Trader has been accredited by the SPD, or CPD, apologies, and we've since taught thousands of people worldwide how to trade for as little as 10 minutes a day, because we figured that a lot of people who discover trading would rather make the most out of trading with the minimum amount of time possible. Okay, so the great thing about trading the daily and the weekly, as hopefully you'll discover if you're not already discovering, is the fact that it allows a lot of time to free up so that you can do what you want to do and when you want to do it. Okay, so that can involve family, it can involve other businesses, or just pure leisure. Okay, so without further ado, let's start in earnest. Disclaimer, there's nothing untoward there, don't worry. So today we're going to talk about how news affects the market, common misconceptions about news trading, and essentially why we don't care about the news and how we can essentially trade it without over-intellectualizing the whole thing. So I just basically want to talk to you about how news affects the market, and this can be anything down to data releases, elections, referendums, news. Generally, what moves the market is disparity in what the market is expecting from a news release or a data release versus what they actually get. So if the news or the data release is worse than expected, you can expect that currency associated with the news announcement. Say, for example, it's in England, let's just say consumer confidence has fallen to all record lows, then that's going to affect the pound drastically if the market wasn't expecting that. Okay, that's a pretty extreme example. But the thing is news is immediately factored into the market as well as soon as it's released. So there's absolutely no point in you taking a news trading tip, or indeed a trading tip, God forbid, from a newspaper, because by the time it's been delivered to the press and it's been churned out and delivered to your door, you can be rest assured the move has already happened. Okay, so conversely, if the news is better than expected by the market, you can expect the associated asset class to go up in well, up in value. Say, for example, the Dow or the FTSE. Say, for example, consumer confidence coming into Christmas, or say, for example, an indicator is Black Friday, and if sales were drastically higher than last year, you can expect that to have a positive knock-on effect with the Dow, the S&P, the FTSE, dare I say, and kind of like risk on asset-based classes, equities around the world. So that's the general kind of like crux between how news affects asset classes. If it's worse than expected, the asset class will go down. If it's better than expected, it'll go up. If it's pretty much dead on what was expected, there won't be much of a change. Okay, so essentially, fear and greed drive financial markets, and news helps as a driver, essentially as a catalyst. And what we do is we essentially use the news announcement as a kind of catalyst to determining an even bigger win, or help us get out of a losing trade as quickly as possible. Okay, so it's merely just something we use. It's a vehicle. We don't really care. A lot of people are quite stunned when I tell them this, but we actually don't care what the news is, when it's released, who said it, or how they said it. We just trade regardless. So here we go. Let's move on to these misconceptions, which many people the world over who I've met and hear about, and what I see in forums and these kind of gossip columns, you see all these all over again. And I just want to really clearly point out that, do you have to be exceptionally smart or gifted to trade news profitably, or indeed trade? No, you don't. Some basic maths is required, that these are, you know, your ability to work out percentages, basic arithmetic, which you probably would have done at pre 11 years of age. Okay, so please don't worry, you don't need to be kind of a rocket scientist to be better at trading. Ironically, it's actually the least cerebral the people are, the better they are in trading. Okay, and that's something which we'll talk about another time. There is a disproportionate relationship between how clever you are and well decorated you are in terms of degree, masters, or doctorate, and how well you do at trading. That's pure and simple. It's quite surprising, but when you look beneath the surface, it's not really. Okay, are people able to get it right the whole time? Absolutely not. Some people get it right some of the time, some people get it right most of the time, but nobody gets it right the whole time, and that's absolutely crucial to appreciate this. And another big one, when people are new to trading, they have this kind of insatiable appetite to plug into these kind of constantly streaming news feeds like CNN, Bloomberg, the BBC. These would actually just confuse you even more, because what happens on these kind of like business news channels is you'll get even more confused. I mean, you'll get in the morning, say for example, you're watching Bloomberg, you'll see some pundit talking up the US dollar. At lunchtime, you'll see someone talking down the US dollar. Then in the evening time, you will not know what's going on, because everyone's saying lots of different things. Essentially, when you're trading the market, you're trading different opinions and sentiments, and no one gets it right the whole time. Okay, when people talk the dollar up, say for example, the dollar down, you need to ask them what time frame are they looking at. Okay, they could be talking about the 1 minute chart, the 5 minute chart, the hour, the weekly, like next year, next 10 years. That's the crucial difference. I mean, they might be right, but it depends when their forecast is. Okay, and that's the crucial distinction. Okay, so is there a holy grail when it comes to news trading? Well, is there a holy grail when it comes to trading in general? Unfortunately not. I tried looking for it in my younger years, in my early 20s, and I kind of got lost looking for this holy grail. It turned into a wild goose chase, because unfortunately it just doesn't. But is it? Let me ask you this. Do you think it's possible to make a decent return trading the news? Well, you can, and I'm going to show you how this is possible. And you'll be glad to know it's actually quite straightforward. And it's just putting simple ingredients together to produce a decent outcome. Okay, so what we need to follow is this. We need a profitable strategy, a stable time frame, positive reward to risk management, that's absolutely crucial. Always use a stop loss, a protective stop loss, which gets you out of the trade if it goes the other way. The ability, my favorite part, the ability to simply sit back, forget about the trade, and relax and do something else. Okay, so when I talk about profitable strategy, I mean it's just preferably something where you can just simply set your orders up and walk away. Supply and demand is a good one for that, or indeed simply buying a pullback in an upward trend, or selling a rally in a downward trend. The bounce or breakout strategy, it could be a trend reversal strategy. As long as it's got positive reward to risk profile, That's key, okay? Simplicity is often the key also, because a lot of people think the more complicated the strategy is, the more indicators they have on their platform, and the more screens they have open equals more money, equals more trades. It doesn't actually at all, and that's another big misconception. Okay, so a stable time frame, another key ingredient in the mix. Daily or the weekly charts, these are a lot more immune to news announcements, okay? So you've got a far bigger stop or difference between your entry price and your stop loss. You're far less likely to be stopped out on these kind of ridiculous spikes you sometimes see in the market, or intraday volatility. It means that we can stay in the game for longer, we can benefit from high profit potential, we can sit back, there's less trade management, even though these trades are far fewer in frequency or far less in frequency. That's quite typical of the daily or the weekly time frames. Okay, so positive reward to risk. This is linked to the reason why we trade the daily and the weekly time frames. We can generally get a far higher reward to risk, i.e. our reward for setting up the trade and trading it is far higher than it would be if we're trading the smaller time frame, like the 60-minute or the 15 minutes. Sure enough, the opportunities on the smaller time frames are far more numerous, but the reward potential, reward profile is far less as well, okay? And I'd far rather have far fewer trades with a higher profit potential than trading a higher frequency of trades with far less profit potential. Okay, it makes sense because it means that you don't have to be in front of the screen constantly monitoring, fiddling with your trades and managing them. That can be exhausting. It ties you down. It's your ball and chain if that's the case. If you're an intraday trader, you'll know exactly what I'm talking about. So as well, trading with positive reward to risk, it means that you can essentially be wrong more times than you're right and still make money overall. Okay, a lot of people have this real kind of moment of realization when they see this for themselves. Keep the risk low, no matter how good the trade looks. That's crucial as well. Even if it looks like, dare I say, inverted commas, the perfect trade, it is crucial that you should just stick to 1% of your trading account's value, or 2% if you've had more than 6 months consecutive profitability, or profitable, sorry, over a 6-month period. That's when you can risk like 2%, but 1% is a good starting figure because it means you can stay in the game for longer. It means that you're not emotionally attached to the outcome of the trade. It means that you don't blow up your account if it goes the other way. It means that you're not forever looking at your trade hoping it will go in your favor. You'll just leave it. You'll be more at peace with your trading. And quite frankly, it makes trading what it should be, a peaceful, relaxing, profitable activity. And risk trade management is essentially a key cornerstone to your long-term survival in the market, as is using a protective stop loss, which is a set of orders with your broker that will ensure you exit the trade automatically if the market does go the other way. Failure to do this will ensure your account is blown up pretty soon, unfortunately. So risk management and having a stop loss, absolutely crucial. Your broker should insist that you use a stop loss. If they do not have the stop loss functionality, it's very unlikely that they don't have this. They do have this, but if they don't, I would just go and get a different broker. It's absolutely preposterous how any broker nowadays cannot offer this feature. Okay, so the ability to set back, forget, and relax, this is the one which a lot of people have trouble with because they're so essentially so used to swapping time for money. They feel that they have to be watching their trades, having an ongoing dialogue in their head when they're watching price action moving. That should not be the case. You should have a very rational idea as to why you've entered the market and have your expectations as to what's going to happen. If it goes correctly, you should have your plan of action. If it goes against you, you should have your plan of action. And you can, if you're trading with money that you can afford to lose, worst case scenario, then you'll be pretty much at peace with the trade outcome. You won't have to constantly monitor it. Trust me, if you watch your trades and you watch the market unfolding and expanding and contracting in front of you after you place your trade, it's a sure way to exhaustion and premature male pattern broadening, hair loss, I mean to say, if you do that. It's a highly stressful activity watching your trades. So that's why I'll just recommend just walk the metaphorical dog. Okay, so risk management technique, like I mentioned, I just want to expand on this. This is absolutely crucial for your long-term survival in the market. What we do is we risk no more than 1% of your trading account. So if you're, let's just imagine the pound signs are dollars, because I know predominantly got a US or Canadian-based audience. So if you've got, say, $25,000 in your trading account, you should risk no more than $250 per trade. If you've got, say, $500 in your trading account, you shouldn't be risking more than £5 or dollars per trade. Okay, so in order to get 1% of your trading account's value, you need to move down whatever your account's value is by 2 decimal places, essentially, to get that. And what we do is we divide that 1% of our trading account by the difference between our entry price and our stop loss to arrive at an amount per pip or per point. Okay, so that is trade sizing. It's 1% of our trading account divided by the difference between our entry price and our stop loss. So if we've got, say, $100 and we've got our entry and stop loss 50 pips away from each other, then that equals our stake size at £2 or $2 per pip or per point. Okay, so in terms of risk, we talked about risk management. Let's talk about the more fun part. That's reward. Risk is pretty boring, but it's essential. But we also need to talk about reward because, frankly, we wouldn't be trading if it wasn't for reward. We like to be rewarded for the risks we take. He or she who dares wins, and I'm a real proponent of that maxim. So we go for setups which offer a minimum of 2 to 1. So if we've got, say, £100 or $100 risked, I don't want to place a trade unless there is a conceivable chance or possibility of the trade potentially making at least double what I've risked. Okay, nothing is guaranteed in financial markets, but of course, this is where we say, within the realms of possibility, if the setup is potentially going to make twice, if it goes to plan or even halfway to plan, than what we've risked on the trade, then it's a goer. If you can't make at least a 2 to 1, even if you're half right, then I wouldn't bother taking the trade. Okay, it's very important to get this right. We always want to trade with a positive reward to risk. Okay, so just to recap, the higher the time frame traded, the more immune to news announcements it generally is, because of the increased distance between our entry price and our stop loss. It means that if whatever the news announcement might be, whoever's saying it, when or where, under what circumstances, it means that if we've got positive reward to risk, that if the trade does go in our favor, it helps to perpetuate a winning trade. If it doesn't go in our favor, then at least we're out of a losing trade slowly, or sorry, quickly, my apologies. So say, for example, you know, you've got a 3 to 1, you've risked £100 or $100 on the trade, and the news is in favor of the trade. It helps to send price action to hit our target far quicker, so we can quickly make $300 or £300. But if we're wrong, at least we're out of the trade quickly, and we've lost £100. So we cannot predict news, okay? There's absolutely no one who can do it all the time, or even most of the time. We don't have the privileged access to inner circle lawmakers or government agencies or anything like that. And, you know, we can always assign guessing as a mugs game. So that's why we don't do it. We just let the news wash over us completely, okay? Because nobody gets it right the whole time. And when we look at the chart, every chart tells a story, and we are essentially the ones decodifying the story of what the chart is telling us. Okay, so as traders, what we do is we keep our overheads low and our risks small as well. Okay, and we trade what we see, not what we think. We're technical analysts that trade the story according to price action. We do not have huge teams of fundamental analysts essentially crunching the data for us. Okay, so like I mentioned, I'm just going to illustrate this point to you. We let reward carry us the whole way, regardless of the news announcements. Okay, there's a 50-50 chance of news either going in our favor or going against us. So armed with that information, we, with our positive reward, we know that, okay, if we're trading a trade with a proper potential of 3%, where if we're, say, for example, we're risking, say, £100 or $100, if we're right, if the news is in our favor, 50-50 that it is or not, then we make £300 or $300, and if we're wrong, 50-50 that the news might be against our trade idea, then we lose £100 or $100. Okay, it's very much like flipping a coin, a 50p coin, knowing that, okay, if it lands on heads, 50-50 chance it lands on heads or tails. We know that if it lands on heads, we can make £300 or $300, but if it lands on tails, we lose just 100. Okay, so if that is a scenario which we're faced with for flipping a coin and being rewarded handsomely for the 50-50 time when we're right, and only losing a smaller amount, comparatively speaking, if wrong, then we'll keep on flipping that coin, won't we? It's exactly the same principle when it comes to news trading. Okay, we use news as a catalyst. Okay, but when we're looking for a reward, we always want to establish what is feasible within the realms of possibility. A lot of people, when they're looking at reward potential for trade setups, they go into kind of fantasist mode, and they basically muddle up between what they want to happen with the best case scenario with what is likely. And the way to distinguish between the two, the fantasists kind of like wildest dreams versus the reality, the cold bloody reality of it, is just looking at the chart and seeing and identifying past nuances that have been established by price action before. So we've got a reasonable, accurate, conservative, dare I say, guesstimate as to what could potentially happen next. Okay, but when it comes to positive reward tourists, the sky really is the limit. But I would like to tell you one thing, and it's a real curveball. The higher the reward, the lower the probability of hitting that reward. Okay. So in terms of finding reward on the chart, what we do is we look for our entry price, which we should know, and our target price, which is at a technical place on the chart where price is likely to meet it. And what we do is we take away the target price from our entry price, and we divide that by the difference between our entry price and our stop price. Let me just illustrate this for you. This is Euro GBP actually quite some time ago, but we've got far more recent examples. So for example, this was a simple selling the top of the range, and we had a difference between 67 pips between our entry price and our stop loss, and our reward was 246 pips. So what we did was we just simply divided 575 pips by 67, and that was a very good reward to risk because it gave us 246 divided by 67 is 3.6 to 1. So say for example you're risking say $1,000 on this trade, and you basically hit targets, whether it's the normal flow of the market or whether it's helped accelerated by a news announcement. You know, you've made $3,600 or pounds, but if it goes the other way or wrong, you've lost just 1,000. So that's the principle of it. So say for example here, pound versus the Australian dollar. This was a bullish pin bar reversal, trading a pullback after a false breakout in an upward trending market on the daily time frame. This was on the eve of the general election 2015, and the Conservative Party, the Tory Party, were neck and neck with New Labour, headed by Ed Miliband. We had absolutely no idea who was going to win the election because both parties were neck and neck in the opinion polls, but we knew full well that, hey, if the results were pro-Tory and the Tories won, the Conservatives won, we knew that the British pound would rally after that, and the FTSE would as well, because the Conservatives Party are generally more pro-business, more corporation-friendly, and markets would like that. Conservatives, by the very virtue of their name, fight change to resist change. They embrace the continuation of the status quo, and markets like certainty, and that in a nutshell, basically. But we had no idea who was going to win, Labour, who are slightly more punitive in their taxation, or the Conservatives. But we did know that if we were right, and say for example we bought and our trade got triggered, our entry above the high of this bullish pin bar reversal, our stop loss below the low, we risked 186 pips, but our target was 838. We knew that if the Tories won, we had no idea who was going to win the election, we would make, well, the market would be accelerated to making a 4.5% gain, risking 1%. If we were wrong and New Labour won, then we would have lost 1%. Okay, so for example, if you traded, say, 1% of a $10,000 trading account, we would have made $450 from being right, and if we were wrong, we would have just lost $100. Okay, so hopefully by now you're seeing that we're kind of like essentially using news as a catalyst. And if we're right, we're rewarded handsomely. If we're wrong, then we lose a small amount thanks to risk management and trade sizing. Okay, so let's talk about a couple of key examples. Brexit. This was a trade setup which made us a fabulous amount of money, and our clients too. We traded the breakable low of a bearish pin bar reversal at a multi-year high, lower high in what we consider to be the top of a double top formation here. And we just placed our entry just below the low, stop loss above the high, and this was in advance of Brexit. this was selling the British pound versus the Swiss franc. We knew that, okay, if this was 6 months prior to Brexit, or 7 months prior to the actual referendum, but we knew that, hey, we've got a technical reason to sell the British pound versus the Swiss franc. It's at a multi-year high, a high that hadn't been breached in over 7 years. We knew that the bounce of this level of resistance was far more likely than the breakout. And if halfway, say for example, price fell down to the bottom of the range, if the Brits, which we did, voted for an independent Britain from the European Union, then we knew the pound would absolutely plummet after that, because of course markets do not like uncertainty. And when we're just pulling out of a 40-year-long kind of like union, then markets see that as uncharted terrain, and they don't like it very much. And true to form, that's exactly what we had. So we had our entry just below the low of this bearish pin bar reversal, stop loss above the high, and we had all of our profit there. If we'd risked, say, just £100, we would have made £1,800, and we actually did have that. It went all the way down to here, and that was our first target, 18 to 1, risking 1%. How about that? And risking 2%, that was 30, well, more like 35% plus. And then, of course, we had other opportunities. We scared out here. We had an opportunity to exit here. We had an opportunity again to sell here, sell here, sell here. So we did very well out of Brexit, and many of our clients did. 18% gain was just made on this one trade at the very top here. There we go, at this point here. But we had all the rest of this chart to make money from as well, and some of our clients did very well indeed, irrespective of the news, okay? We avoided the markets just because of some kind of major news announcement, or even a minor news announcement. Nobody would make any money because the markets would just be absolutely dead. Nothing would ever really happen in them. Markets are driven by news, and it's our ability to hop onto a fast-moving market and piggyback the news announcements. So here we go. We've got trading the general election in the United Kingdom. We've just talked about this, and this was the British pound versus the Australian dollar. And like I mentioned, we predicted that the Conservatives would be victorious in 2015, despite being neck and neck in the opinion polls with Ed Miliband's New Labour. And we assumed, like I just mentioned, that the British pound would rally across the board, would have a strengthening pound if the Conservatives won. And if New Labour won, the pound would plummet. So, bearing that in mind, we knew that, okay, we had a technical setup for a buy with the British pound versus the Australian dollar. So we knew that, okay, technically it's sound, it's a fast breakout, an upward trending market, so it makes sense to, well, go with the trends as well. So we literally, first target was the previous swing high, and we knew, okay, if the Tories won, we'd be in the money. If they didn't, we'd lose a small amount. Okay, so entry was just above the high of this bullish pin bar reversals, top loss below the low, and we had a decent 858 pip profit potential, 4.9% gain, risking 1% of our trading account. If we were risking 2%, then of course that would be 9.98%. Again, just doing that, and of course that's what happened. The Conservatives won, and that's really, as you can see here, that major succession of buy bars here pushed price up. We had the retracement, and then price squeezed up after that, and we were able to take profit at the very just below this spike here, and that was a very easy, dare I say, low-hanging fruit. But of course, you know, sometimes there are anomalies, and this was the case in the case of the Scottish referendum, where we saw a bearish pin bar reversal at the FTSE 100 index. We had this penultimate all-time high here, and we had a bearish pin bar reversal at the top of it, which gave us a sell signal. And we had the Scottish referendum, where, you know, the fate of a 300-year-long union with Scotland was decided by the Scottish residents, i.e. they potentially wanted to, well, they're voting as to whether they wanted to leave the United Kingdom, so that would be the breakup of the United Kingdom as we know it, if they did vote to leave. But anyway, we had this technical setup to sell the top of this penultimate all-time high here, which has been a well-established level of resistance. So what we did was simply placed our order just below the level, stop loss above the high, and we had all this profit of that range here. It was a fantastic profit potential we had. So we were risking, say, 38 points in pursuit of 330 points. Of course, ideologically speaking, I did not want the Scottish referendum to dictate the breakup of the UK. I love Scotland. I really do. I think it's a great country, but I don't think they will fare well on their own at all. So obviously, even though I would have had a hugely profitable trade if the Scots decided to leave with the referendum, I would not have liked it at all. But sometimes anomalies happen because we place this trade, the Scots are voted to remain in the Union, and actually the FTSE just went down anyway. So hey, we were expecting the FTSE to rally, but it didn't. So there are anomalies. Okay, so some clients did very well from this one, regardless. Okay, even though the Scots decided to remain in the Union, the FTSE didn't rally. It just bombed anyway. But hey, you know. So let's talk about now removing our emotions from trading. I don't know how we're doing for time. Tanya, are you there, Tanya?
Yes, I am. You have about 5 minutes.
Okay, excellent. Thank you. I didn't want to cut into anyone else's time. So trading should make you feel, or it probably does make you feel at the moment, if you're not profitable, you've got a fear of losing, fearful of winning, your outcome attached, entitled to wins, doubtful of your strategy and yourself. But it should not be like that, because end of day or end of week trading, set and forget trading, should make you feel calm, patient, and you can do that by simply adhering to the rules we discussed, by keeping the risk small and targeting trades of high profit potential, and just essentially letting the market do the work. You set your orders up and forget about them on the weekly time frame. Okay, so trading should be a peaceful and relaxing activity, and this is where we separate our emotions, our head from our heart, essentially. Okay, so we do this with having realistic expectations on trading. We never trade with money we cannot afford to lose. We never ever risk more than 1 to 2% of our trading account's value. We always trade setups with positive reward to risk. We always use a stop loss, and crucially, we let our winners run. Okay, so news is no more than a catalyst to helping us realize big winners and the outcomes of losing trades. We can piggyback fast moves and basically help jump onto big moves with hundreds, sometimes even thousands of pips reward if the news goes in our favor, and quickly exit a trade if the news goes against us. Okay, we cannot predict it the whole time, but there is a 50-50 chance of the news either being in our favor or not. Okay, and if we're trading with positive reward to risk, then we can overall make more money from being right half of the time, or even less than half of the time, than we're wrong and losing as a result of news not being in favor of our trade. Okay, so I hope you've gained from that. I know that we started a little bit late today, and I do apologize for that. Technology can be a bit of a mess sometimes, especially as we endure bad stormy weather in London at the moment where we're broadcasting for. But I just want to kind of reward you all for taking time out of your busy days, your busy schedules, for coming today. And we're doing something exclusively with Traders Talk Live, and I've cleared this with Tanya, and what we want to do is give you exclusive access to our flagship Ultimate program, which is being accredited by CPD. It's valued at $1,997, and we are inviting you to a 1 month's test drive for $1. Basically, you get access to absolutely everything. It is a subscription service, which costs $160 a month. You can cancel at any time, but what we're doing is we're waiving your enrollment fee of $252, and what that will give you to is everything. We do not hold anything back. You have access to all of our trade ideas, webinars, strategies, video tutorials. You've got a moderated forum. We have many free bonuses like our Trader Zen Trader Hypnosis audio pack, which is pretty cutting edge, actually, if I say so myself. We've got pattern recognition software. You've got access to over 50 years experience in the markets. We work alongside other traders as well who all have been trained up to STA standards, and much, much more. So if you do fancy it, we have this offer available until midnight tonight only, Eastern Standard Time. That's New York time. So if you fancy it and joining our growing trading community, please join us at thelazytrader.com/forex training. Buy the Ultimate program, type in the promo code Traders Talk, hit apply, and you'll get your $252 reduced down to $1. Okay, so hopefully see you on board. No love lost if you don't, but if I say so myself, it's great value. It's the best value we've ever given. And I would like to thank you very much indeed for your time today. And if you've got any questions, do feel free to ask them either now or drop me an email, rob@thelazytrader.com. Thank you very much indeed for your time.